This episode is sponsored by Property Filter. Find great deals faster.
Hello and welcome to the Financial Freedom Podcast, sponsored by us at Property Portfolio Building. This podcast is designed by real people on their journey to achieving financial freedom, and we'll focus on people who've either already attained it, who are joining us on that journey, or maybe a specialist topic that can help you build your technical knowledge to achieving and maintaining that financial freedom. We hope you enjoy it. Valuation. Let's talk about valuation for a second, because you've done all the things technically for the lender, but there is this uncontrollable element within there. So let's talk about that, because that is the one of the key things, isn't it? And this is why having a good broker is really important.
Yeah.
A good broker that understands small scale development, has multiple options for lenders who've lent to your type of project before, whatever it is, whether it's HMO flats, whatever it is, new build. That's what you're looking to do. Your broker is experiencing there, and they have more than one opportunity as a lender, because they only have one lender. They go to that lender and they say no.
So the valuation survey is very important. So ideally, you want to be able to have a valuation survey from a surveyor that you understand how they value the properties. Is it similarly to how you value it? And in the background, you need lots of sort of data and information that is like a valuation.
That's data for everyone else.
Data, yeah. And in a pack that here's the rental comparables in the area, here's the sales comparables. This is how we came up with what we did.
Yeah.
Also, if you're doing the initial valuation for the purchase and the report, before you've done the works, you want photos showing this is what the end product's going to look like.
Yep.
Here's our design drawings to show what the layouts are going to be, as much information like that as possible to get the valuation surveyor comfortable.
Yeah, and that's one of the key advantages of working. I mean, it's a plug for us here, isn't it, for working with a company like ours who've done multiple of these.
Yeah.
You have all the comparable information, and you have the...
So in our agencies,
and so the images.
We've got, 130, 140 rooms in a lot of the areas we work in as comparables. Sometimes we're reletting because the changeover of tenants, so they're actually live comparables that can be used in those areas. So we can build up our own... database and
database.
Both are right, and use that as comparables, because even in our valuation surveyor packs, like some of the sales the comparables for the rent are our properties, so it's really handy to build up that.
There's a fundamental thing here as well, and we've fallen foul of this, so we'll talk about this, which is absolutely know your end scope. What is your exit? What are you going to be doing? And that everything is in line with that. So that if you need planning, that the planning is in line with that. If you've got drawings, the drawings are in line with that. So it's not just you saying something; it's everything is in line. Your scope of works is in line with that.
Yeah.
And that there's no grey area at that point, because you want your surveyor to come out and know what he's valuing.
Yeah.
And also that the lender, the broker's going to go to the right lender for what it is. So if you change your mind and you've got the wrong lender. And they instruct somebody like on a bricks and mortar requirement, as an example, because they think it's going to be flats, and flats hold a better value than commercial in the area.
Yeah.
But you change your mind and say, I'm going to do HMO, but I'm going to continue with this journey. That's a major problem, because you're not going to get the right valuer and then not have the right lender. And we had that problem, right?
Yeah, absolutely right. Yeah. So it's really important that your broker understands the sort of lender and product you're after. And then that sort of lender has the right sort of valuation surveyor panel that are going to, value it in that sort of method.
Yeah.
Those things are really important. If you fall foul of any of those, you'll get the wrong lender, like you said, that's going to give it a bricks and mortar valuation. And it's just not going to suit the way that
we had that classic example as well, didn't we? We bought a property at auction.
Yeah. And
the reason that we bought it at auction was it already had plans in place to do some stuff. We knew we would have to get planning on one element of it. And so the property was a commercial unit. It already had planning and some development works done to the upstairs, which was 2 3-bed flats, which we were going to then use as a 6-bed HMO.
Yeah.
So there was a lawful certificate requirement there to do that. And then downstairs was a commercial unit.
Yeah.
And we were going to convert that to a 4-bed HMO.
Yeah.
Okay. The planning for the downstairs unit was already in place for a flat. For 1 3-bed flat, I think.
Yeah.
So because there was planning, and we were going to then go and do something else with it.
Yeah, we had to get 2 new planning applications.
Yeah, we had to get 2 new applications. So when the lender came to, when we came to do the purchase and the bridging and then the development finance, because we applied for both, if you remember this.
Yeah.
So we applied for bridging and development finance. they sent a surveyor out, and that surveyor looked at. I mean, he was awful anyway, right? This surveyor, which is why it's such an important part. But he only appraised it as 3 flats.
Yeah.
Not a 6-bed HMO and a 4-bed HMO. So he gave us no development uplift for those things. He gave us no commercial element to that valuation. It was just 3 flats. So we'd asked for a valuation of around, I think it was about 600,000 or something like that. And
I think it was about 550 even at the time.
Yeah, because he had 11 income streams.
And the value he gave us was about 247,000 or something like that.
Yeah.
But then the final value, once we delivered it all, we got the 2 planning approvals.
Yeah.
Was 617,000. So
yeah, exactly.
So yeah, but as a result, we had to raise full private finance for the development.
Well, we'd already exchanged contracts. Yeah. It was an auction.
Yeah,
so we were in that position where
so a little bit of a risk there, but so we don't recommend that. But it did pay off in the end.
Yeah, well, absolutely, and it just goes to show that if you don't get that part right, and this was very early on for us, right? So we've learned these things. So we're here telling you not how to avoid it, right? So that's the good news is about working with somebody like us or listening to this type of podcast is you can learn these things, right?
Yeah.
So we still got the bridging for the purchase, which was good. Because that would have really scuppered us. But they couldn't lend us for the development because they just didn't believe that.
But then we were still confident. And I think, even when we raised the private finance, we'd already have some of the planning approved and stuff like that. So we were really confident that, we were going to deliver what the plan was.
Yeah. And that was also the project where we got the deed of subordination because we then went to those private lenders and said, lend us some money. And they said, yeah, no problem.
Yeah.
But then we sent them the deed of subordination.
And they read it.
And they were like, what's this?
And they freak out. Yeah.
Yeah. So... okay, cool. Right. So we've got everything right. We've done it properly. So we've done a proper appraisal. We've got everything in place. We know what the planning outcome is going to be.
Yeah.
We know what we're raising. We've raised it. We've got deed of subordinations in place. We've got bridging approved.
Yeah. And then you go through the legal process. We won't into detail of that, but you get the purchase done. You get the finance in place. As it goes to site, if you got development finance, you draw down the development finance. You pay the builder. Works are done. We're fast forwarding a bit because we're not talking about the detail of the build element and stuff like that.
Only one bit of the build element, I will say. If your builder requires an upfront deposit and you're working to valuation, it's likely a lender's going to pick up on this and they're going to reduce your loan.
Yeah, which is why the importance of, say, the JCT contract being in place is important. Because if you've agreed in the contract you're paying your builder in arrears on monthly payments, that works fine with the development finance.
Yeah.
If, like you said, the JCT says the builder gets 50 grand up front as a deposit or something like that, then the lender will see that and they'll ask you. Obviously, you have to show proof of funds for that.
Absolutely. And it's also the timing as well, because you need to be clear with your builder what the timings are and their payment terms. So our timings is 4 weeks of work, you invoice, and then you give us 1 week from invoice for after that 4 weeks for us to organise the monitoring surveyor.
Yeah.
The monitoring surveyor then reports back to the lender and we get another 72 hours for drawdown.
And then to pay.
Yeah. So that's how we work it.
Yeah.
It's obviously you need to be builder friendly, and if it's your first time, you might not get that. But anything that you need to pay up front, the lender will likely ask you to show that you have those funds before they will lend to you.
Yeah, exactly.
So if you have to pay the builder's first month,
and that is really important. And the key thing is that, like you said, the finance agreement lines up with your actual payment agreements with all your builders and suppliers and things like that.
Yeah. So even if you've borrowed 250 of that 300 or whatever, if you've got 50k as an example, and that's all you needed, if your first payment to the builder is going to be 25 grand, you will need to demonstrate you have the 25 grand.
Yeah.
And then they will pay you back.
Absolutely.
Yeah. Okay.
Right. So now we've got to the end. We're done. We've got the build process finished. It's it's the HMO. We're done. It's furnished. It's ready for rental.
Looking sexy, everything's
looking sexy. Yeah. Now we're into the second half of the game of 2 halves, and this is the exit.
I think I've reached an age where I can't say that anymore as well. So I think when my wife watches this, she's probably going to cringe at me saying that. Sexy. I think I'm now over 40, so I don't think I'm allowed to say those words anymore. But so it's looking good. It's looking cool.
Yeah.
And
nice professional photos, nicely dressed is what we do, and really, really high-end ads. We get videos as well.
Yeah.
With shortcuts of the rooms, all these sort of things, and you're doing a great sales process, achieve the best rents for the best tenants.
Yeah. Let's say we've done all that.
Yeah, we've done all that. So now we're moving on to the mortgage product as the refinance.
Yep.
Because you're going to move to a lower rate.
Yeah. So we'll talk about exiting onto a hold product, so refinance.
Yeah,
we'll talk a little bit about sales, but
this is to keep the property cash flow. So like we said, your bridging finance might be cost you 16-17%, but a new mortgage loan at the moment for this sort of product is maybe 5.5 to 6.5%.
That's for a HMO product.
For a HMO product at the moment in a limited company, plus
2024.
Plus fees. Again, they add on the arrangement fees now, and
depending on when you're watching this.
Yeah, depending on timing, etc. So yeah, that's just a bit of a guide in July 2024.
Yeah.
So who knows what will happen, but yeah, so you exit to that product. So the key thing to that is, again, the new lender will need another valuation survey.
Yep.
To base their lending on and their security. So you might get up to say 75%, loan from the bank.
Yep.
And that will be 75% of the valuation survey.
You can get more. You can do 80, but you need to be able to prove that you can pay it back. It's all about the affordability.
Yeah, and you want to stack your deal with the rents and what cash flow and funds left in, and work out what works the best for you, basically. And you might want to, the more you leverage, the more risk you've got if the market was to crash and things like that. So you got to weigh up your overall.
Yeah, and I guess 75% on a commercial product is probably a reasonably safe.
It's pretty safe, isn't it? The market's got to drop 25% at that point.
Yeah.
For it to be a problem, as long as the valuation is the right number. So I think the valuation being the right number is important, because if it's way too high, you're adding risk. Even though you might get all money out, you might be adding a lot of risk and not getting a lot of cash flow.
Yeah, in a way, you don't want it overvalued.
You just want it valued the right
price.
The right price. If it's too low, you've got too much money tied into it, and if it's too high, you're over leveraged, and it can be too risky.
Yeah, no, absolutely. And we're going to talk evaluation again here. So if you're in the bricks and mortar valuation area, it's reasonably predictable, right?
Yeah.
Because you can say, right, the house that's got 4 bedrooms down the street, or
in a quarter mile radius.
Sold last year at let's say $500,000. This is the same size per square foot. I want the same as a valuation.
Yeah,
regardless.
As long as there's similar specification.
Yeah, and it's done just recently renovated. The fact it's then a HMO, maybe there's a little uplift or not. I don't know, but chances are it's easy to do, right? You just base it on that, and if you've done it correctly up front, you've already got that information, and your first valuation will give you that.
So HMO, to start with, it's harder to find the sales comparables because there's not a lot getting sold. People hold them for cash. A lot of people that do sell them will sell them, privately or through a specialist agent. So it's harder to find the sales comparables.
And there's no way to search on the land registry or on right moves and things for sold comparables. If you put in HMO, it's very difficult to search. So we've got a list of 30-ish, I think.
We keep building it up because we actually get them from the valuation surveys, and then we record it, don't we? To keep building up. So that's a good way to build up the sales comparables in the areas.
Yeah, absolutely. But bricks and mortar aside, that's easier. Commercial is more difficult.
Yeah.
And that's when these things become more important, right?
Yeah.
Because you need, there's less sales comparables. Because if I can compare against the house down the street, which is a resi, but this is a HMO, but that's sold at that price and this is sold at a similar price, that's easy.
Yeah.
But if I need to be getting a valuation of around, 20%, 30% more than that house down the street because it's had so much spend.
You can do refinance comparables though. So we've got quite a few HMOs in certain areas, and like Salford Council as an example. We can use the refinance valuations as comparables, to another survey and say, look, we've had 3 valued in half a mile at this percent, and they can take that on board. So building up that database of information is very important as well.
And it's really key that at this point, this is I don't want to say this is the most important valuation.
Yeah.
But in my mind, it always is.
Yeah.
They're both equally important, that you've done the prep work and everything's lined up.
Yeah.
But this one will make or break.
Yeah, because if you're going onto a mortgage for 5 years, as an example, because generally at the moment it typically might work out best to be on a 5-year term.
Yeah.
And depending on the lender and things like that, you're stuck into that value for that term. That's your funds in or out, and that's your rate that's fixed for that term. So it's important to get it, right. Whereas that initial valuation, the only key risk there is just how much funds are needed in the first instance. Like we talked about, the bridging lender might restrict their lending a bit. That's the only real risk from the upfront valuation.
Yeah.
Stop the podcast now. This episode is sponsored by Property Filter. Property Filter is the #1 property tool for today's property professional. It brings in all the data points and sources from all the property portals and auction sites into one convenient place. Then you have the option to overlay all the clever strategies found in the property filter blueprint to find motivated sellers faster. Now, we use it on a daily basis. It saves us over 80% of our time when looking for properties. And if that sounds like something that you want in your lives, please go to register.property-filter.co.uk/PPB, which is the discount code for this podcast. You will get 2 weeks free and a discount on your first month. That's it from me. Back to the podcast.
So just going down to that valuation. So knowing the surveyors is quite important. Knowing the lenders and what their criteria of is equally important, because you're going for this, especially in this commercial or hybrid area where we sit.
Yeah.
And we sometimes hear things like, I only heard it yesterday from one of our other clients. I've been told, I don't know who tells them this, but I've been told that you can't get commercial or hybrid valuations on 5 and 6 bed HMOs. Where we have about 20 to 30 examples of where that has been.
Yeah, I've never not had it. Yeah, so my portfolio for clients, we've never not had it. Is the response.
But going back to that, it is because it is a specific product. So like our smallest product is a 5 bed all en suite. Yeah, dedicated bathroom. So it's not a house. It's not comparable to anything else. It is specifically for that use.
Yeah, agree.
So, but going back to the valuation part, there is a difference here. So what you're looking to do, so if you know your valuers inside out, your first valuer, if you have to use 2 different ones, your first valuer, if that's the kind of valuer that uses a commercial or hybrid market rate rather than passing rate rents. So and there's a big difference here, right? So a market rate rent assessment is based on, I go onto Rightmove, and they use Rightmove more than Spare Room, even though Spare Room is the number 1 HMO comparable database in the UK.
Yeah, which is why in our valuation packs we give the Spare Room comparables.
Yeah. And we also advertise our rooms on Rightmove when we get our valuations done. So they can have some other comparables. So they can
see it,
yeah. So, which is a really good tip, actually. If you've got multiple rooms, stick them on Rightmove so they're comparable, put them as rented.
And don't forget, tenants change over, so you can continually market a property and build up a waiting list for tenants. So it's not even, it is legitimate marketing as well at the same time.
Yeah, absolutely. So you can actually advertise it and then put it as rented. The same day. So it just shows as rented if you do a search on it.
Yeah.
Anyway, so that's probably another topic. But in terms of the difference between those 2 things, if you know your surveyor is always going to give you a market rent assessment, then all they're going to do is look at the rents in the area, look what's rented, and give you a middle figure.
Yeah.
Right. So if you do what we do, which is we go for the higher end products, we're top 5% in all our markets, right?
Yeah.
There's always that 1 or 2 that might be slightly more highly spec than us.
Yeah.
But in the main, we're top 5% in any of our HMO market areas. So we want to be achieving the valuation on it being that product.
Yeah,
that's what we want.
We want the valuation on the passing rent, which is what the actual rents have achieved.
Because the passing rent dictates the quality of the product.
Yeah,
for a HMO product and for rental, for any rental product. If your rental product is excellent, you're going to get the top rents. If your rental product is medium, you're going to get the medium rents. Generally, and those markets obviously have a top and a bottom to those markets. But if you're going for working professionals, all en-suite properties, comfortable living environments, lovely colour schemes, interior designed to support those work from home stations, that kind of stuff, then you're wanting to get those things. So what you if you know 2 surveyors and you have to use 2 surveyors, one of them uses passing rent, one of them uses market rent. I'd almost be always tempted to use my passing rent surveyor at the end.
Agreed, because it's purely just on your product at that point and what it's rented for. So this back end, it is important. It's a bit of a balance because you want to pay back the bridging lender quickly and you want to get onto your new product, but you don't want to do it too fast that it might affect your valuation. Yeah. So usually we try to run the process and, we have the lettings process happening and then we know that the refinance is happening in the background. So we can basically book in the valuation survey the day that the property is either fully tenanted or maybe like there might be 1 room that's still left to go or whatever and going through referencing checks or something like that. So it's that sort of balance and that sort of timing to be as efficient as possible.
Yeah.
To give you the best chance of getting the highest valuation and to do it in the best sort of time frame. So you can do it quicker, but you might risk your GDV valuation being lower with lower rents.
Yeah. And you also need to kind of be aware of whether or not your surveyor uses a gross rent or a net rent.
Yes.
because a gross rent's just a simple calculation based on the annual grossing predicted without voids.
So we know a surveyor that we deal with that his net rent is just 3% lower than his gross rent base. It's a bit of a guide for people. But it's interesting we're talking about this topic because I actually did a summary of our last 11 valuations for HMOs.
Yeah.
And the average gross rent of the passing rent, so the actual rent achieved, was about 12.37%.
12.3.
Yeah.
Yeah.
Just as an average across the board. Obviously, some of those areas were different and higher and lower, but
but even then, that's because on some of those we've used a market rent surveyor when now we would.
Yeah.
So that's a really good tip, isn't it? Because that's something we've learned across that 11 projects, right?
But also sometimes you have a surveyor who uses the market rent, but they might apply a lower yield. So the actual end value might be the same as a surveyor that uses the actual rents and puts a slightly higher yield on it. So it might end up being the exact same value.
Yeah, and that's a good point because your yield is the key thing, and this is a common thing as well. If you're just starting out and you've never done a yield assessment before, the lower the yield percentage number, the higher the valuation. Right? And people mix that up all the time. Because if you've never done it before, you don't know what you don't know, right? So basically, a 10% yield is more valuable than an 11% yield from a capital value of your property.
From a valuation perspective. But then a higher yield is, higher cash flow.
Higher cash flow.
Yeah.
So in our area, we're in that sort of 11 to 13%.
Yeah,
roughly,
predominantly for gross yield. Yeah,
gross
it's a good guide
on
for
valuation.
This all depends on using the working with good valuation surveyors and the right sort of lender. Yeah. So like you said earlier, sometimes you've got to go through a couple of surveyors that don't work in the way you do.
Yeah. At the start of the project,
you just don't accept their quotes basically.
At the start of the project, it might cost me 20 grand, 30 grand more. Yeah, I might have to put 20, 30 grand more in.
Yeah.
At the end of my project, but I get that back. At the end of my project,
and sometimes
that's more painful for
me. Exactly. And then sometimes when you get the valuation surveyor quotes, sometimes cheaper is definitely not better.
No.
If someone's at £300 and the other quotes are at $2.5 grand. They're just really going to do a copy paste job. They're not going to look at it in a commercial way necessarily at that cheap quote.
It's not that they're bad at their job. It's that they don't do what we do.
Yeah, they don't value it in the way they do it. And it's weird, isn't it, that sometimes even though this criteria from the lender is the same with say 5 different valuation surveyors, you could have 2 or 3 that will value it in the way you're thinking and the other 3 will value it in a complete different way.
Yeah, and we've got 3 valuers that we would prefer to use at all times. And one of those went through some staff changes, right? Recently, and we don't use them now.
Yeah.
Because
different personnel within the business, and they didn't understand
from another company that we wouldn't use anyway.
Yeah, and also they didn't understand the Manchester area as well as a result, because the guy that was there was from the area, knew the area well. So they were just more conservative. So it does change over time as well.
It's always
people. It is people. Property is always the same. Relationships with people is what gets you the results.
And what happens when things go wrong?
With the valuation survey. So if there's a down valuation, obviously you can appeal it. So sometimes valuation surveyors will accept it. It's very difficult to do. We had been able to do it with 3 projects, and that was
three projects.
And that was because the relationship we had with the owner of the business. So if you don't have those relationships, it's very hard to overturn. Some surveyors, no matter what you do to appeal, their policy is obviously it's not like a live policy or whatever, but they just don't accept it. They'll just get it and say, no, I've already done it. I don't agree with it, basically. And they can do that. And then it's very difficult to escalate it any further because you go into RICS at that point, and you're going to spend a lot of time looking at their chartership and stuff like that. And it's
if evaluation
going to be very, very difficult.
Evaluation fails, what happens then? Because if you literally can't accept that valuation, because if it's too low, you've got it wrong. The lender's wrong.
If you can't challenge it and get overturned, you're probably just going to have to look at a new lender.
Yeah, if it's that bad.
Yeah, if it's that bad.
Yeah.
So we have had to do that sometimes.
Because the lenders won't instruct a new valuer.
No, they've said.
Well, I don't know whether that's true across the board. I have to say that's true, but I know that
worth reinvestigating that. But
none of ours do.
Generally, they don't accept another surveyor just to come in and do it. You can't have more than one bite at the cherry, basically.
Yeah. So it's really important to get that part right.
Yeah.
And so what happens if things go wrong is basically Phil Lastering, the owner of the business that's done the survey. That's what happens normally.
And talk through and then say why it's
2 days
incorrect. Yeah.
providing
put a very detailed challenge because even if you've got a good relationship with them, you know, they want to make sure that the info you're giving them is new or different to what they've already got.
I do wonder whether or not they read it or they just go, I'll just go with it, you know, kind of thing. Because I think the last one I put forward, the last valuation challenge I put forward was like 4,500 words or something like that. So I don't know whether or not they read it all. But yeah, I mean, it has to be something. And the key things that, if you've got like direct sales comparables, or they've used a market rent and you've got another, because they couldn't find anything on Rightmove, but you've got 40 market rents on Spare Room as an example, or you've got 40 properties rented in the area, and they've just not taken that up as part of the
they just haven't used that information.
Or they've not looked at the area. That's a very good one. You know, if the capital value in the area of is higher, even on a commercial valuation, they'll just use a common yield sometimes, and a lot of the valuers just use a common yield. So they'll just use the same yield for everything.
Even though areas are different.
So we've got pockets of areas, which is where everybody wants to live. You know, the capital value is higher, you know, in those areas. So if you get a property in that area, you would expect a lower yield on that. And we try and confirm it up front with the surveyor that this is it. But then if it's a more junior surveyor who then just gets it signed off, or it's not the original person you spoke to, those things can happen. They're good reasons, right? They're good reasons for challenging. Just because you think that they're wrong is not necessarily.
So time frame is really important because, you know, like we're talking about these projects, we aim to get fully refinanced for either ourselves or our clients. If it's a 12-month loan, we try and aim in 8 or 9 months. And then, you know, if you have to change lender, you've got a 3 or 4 month buffer to then go to a new lender and get it done and still pay back the loan in time. So that's like the contingency planning that can get done.
And it's the same principle for whether it's HMO or flats or whatever it is. It's like you've got to look at the valuation as a whole if you're keeping the product.
Absolutely.
To tenant or not to tenant?
For the valuation? My preference and our preference is to tenant because we have the live ASTs.
Passing rent.
Yeah, we want the passing rent. And we can give it to the surveyor. And to be honest, like most surveyors we work with, one of the first questions they ask is like, provide me with the ASTs. So if we haven't rented it, then it's like, we haven't rented it. This is what we're going to get. You know, it's not a real thing at that point. And then they are going to use the what they would consider the market rent because there's no live ASTs in place as the passing rent.
And that's a mistake that people make.
I do know some other investors who don't do it that way. They do it quicker and they just try and convince the surveyor that, you know, they're going to achieve X.
I know some people that make it up, and that's dangerous, right? So they make up false documents. You know, I would never do that.
No, absolutely.
So I'm going to give a tip for anybody who listens to this, right? So, and it's regarding getting your revaluation done on a HMO. Be specific with your broker that you want the HMO mortgage to be issued on application for the HMO license.
Yeah, very important. Very important.
Not the receipt of the full HMO license.
Because
the council.
Anyone here that's dealt with HMO licensing, it's from the housing department and the council who are usually understaffed, sometimes no staff in that department.
Yeah, we've got one at the moment. We've applied for license, and the email back was there's currently nobody in this department, but your application.
Yeah, so even though you comply with it completely, the council might take months and months to even view the property, and then further months and months to issue the license. So like you said, you've legally done what you need to do. You've complied with licensing requirements. You've applied for the license. You've potentially paid the invoice. But the council, because of staffing issues and all these sort of things, and because it's the council, can be much slower than.
And that will hold you up more than anything else. That can be the most expensive mistake you make in your property project. Is that not if the lender says I'm not.
And then you need to also tell the solicitors, because sometimes you've agreed it with that lender, but then the solicitor hasn't been told that. So then he asked for it and said, I can't complete this in place, even though you've already agreed the principle with the lender.
The computer says no.
So you need to communicate it with your solicitor and your lender at that point. That's what you're doing.
Yeah, and the legislation around that is that you only have to have applied for it. Number one, that's your legal responsibility to have applied for it. And you actually only have to apply for it within 6 months, right? Or something like that. 3 months. I'm not sure.
We do it as quickly as possible. And we recommend just to do it as soon as you've got the documents, just apply for it. I believe the general guidance is about 6 months, but you should be able to do it much quicker than that.
Yeah. And that's a really good tip, I think, guys. Just because if you communicate it early enough on your refinance, then generally it's not a problem.
Yeah.
So, and we've had a refinance which it was 6 weeks post application for the refinance. We've had one which was 4.5 months because of a license application.
Yeah.
So
and vary depending on that, definitely.
Yeah. Okay then. And then everything's gone well. You've got your valuation, you've got your ASTs, you've rented it out, you've gone through the legal processes, and you have refinanced your property. I think there's lots of memes around about like property investors the day before refinance eating like soup and potatoes raw from the bag, and then on the next day they're on their holidays or whatever.
You got no cash, and then this big lump of cash lands in your account, and then you got to pay back your private investors the next day, and then it's gone again type thing. But
okay, and then you can just go on and enjoy your returns, right? That's for however long that HMO is. But then it's all about management.
Make sure it's really well managed and maintained, and you want to keep the property in good condition.
Yeah, we talk about that separately
in more detail,
in another technical one.
Yeah.
So to summarize, we're just going to do a scale of best return when using of how to finance your deals to least return of how to finance your deals.
Yeah.
Just so people can understand like the different things that they can do. So I'm going to lead off with the best return on a project is to use all your own cash and not have to pay anyone.
Yes, absolutely, because you're saving.
Because you're saving on the initial valuation surveyor, the lender's legal fees,
arrangement fees, admin fees,
all that kind of stuff. Yeah. The second best return is to use private investment for all.
Well, I think the second best might actually be a combination of, say, bridging development finance and more cash. So you might be able to buy the property with cash and then have development finance. Or you could buy the property.
I would argue buy the property for cash and then use private investor money.
Yeah, so obviously it really depends on what sort of rate you give your private lender.
Yeah, of course. Yeah,
you can agree.
It's 17.
It's whatever you agree. So if you're agreeing a really low rate, obviously that's definitely the next best option. But if your rate is high, it might not be as good. So it really depends on that scenario.
Yeah. But those first two sort of scenarios where you're using all cash or all private investor funds, they're hard to do, right? Yeah. I don't think I've done one yet with either of those things. So they're hard to do. So most people are then heading into the next part, which is what you just said there, which is a combo, right? Which is a combination, the middle ground of it, the combination of putting more cash in and then having something. But what I would do is I would separate the purchase and the development.
Yeah.
And then depending on the deal, if you have the cash, I would totally fund one of those things.
Yeah.
Because you don't want to do part here, part there. If you can help it, because that's much costlier.
Yeah.
You want to separate those two things. Traditionally, most people like to bridge the purchase, and it's easy because it's easier to get lending.
Yeah.
But if you're doing something like it requires planning, or there's an auction process, or any of those kinds of things, it might be better. It might be better to use cash for the development. So to get cash for the purchase, and then draw down funds against the property for the development.
And then the final model is leveraging as high as possible, using as much bridging development finance as possible, and then filling in with the gap of the other funds needed by you or from a private investor. So just as a bit of a guide on returns, maybe. So if you're fully leveraging this example we did, that's a 6-bed HMO, you might be getting with funds out at a good valuation, commercial valuation, maybe 13-14% at the low end, and then you can achieve higher than that, obviously, but at the low end, that's the sort of things we work with our clients. And then if you did the blended finance approach where you might fund the refurbishment, bridge the purchase, or cash fund the purchase and development finance for the works, your return on investment is probably going to be 5 to 7% higher for the same deal. And then if you're cash funding, it might be 10% plus higher, 10 to 12% higher maybe as return on investment. So depending on your funding mechanism, the same deal can be between, say, 13 and 25% lower end return on investment. So it does make a big difference.
Yeah, absolutely. It's huge. And just from a capital return as well. I mean, if you think about, like you said before, so it could be about 17%. So for every 100 grand you borrow, 17,000 cost if you're doing the full leverage, which is your least return, versus 17 grand saved at the top if you use just full cash. And then anywhere in between is like, if you use 50-50, then it's half of that 17.
Yeah, exactly right.
The grand spent. So you can just work it out that way yourself as well. However, there is a worst return, which is you just don't do anything.
Yeah.
And then you don't have any deal.
So bridge. If you're using bridging and you need less cash, it's a good enabler to get you going.
Yeah, absolutely.
your first deal, your second deal.
I couldn't have done my first one without bridging and development finance.
No.
The important thing.
I definitely could have. I couldn't have done 10 in a year without using.
Well, the important thing is to move forwards.
Yeah.
And
take the action, get going,
but
in a responsible way, and knowing what you're doing, working with the people that know what they're doing as well.
Yeah. So that brings us to the end. I think that was quite good.
Yeah.
I hope you enjoyed that. And that brings us to the end of another episode of the Financial Freedom Podcast, sponsored by us at Property Portfolio Building. Finance, the game of two halves. First half, how to fund your deal. Second half, how to exit your deal if you're holding the property. We hope you enjoyed it, and we look forward to catching up on the next one. Until then, bye for now.
Bye.
Thank you once again for joining us on the Financial Freedom Podcast, sponsored by us at Property Portfolio Building. If you want to get in touch with us about today's podcast or any of the learning topics that we've gone through today, you can email us at podcast@invest-prop.co.uk or get in touch with us with whichever your social media platform of choice is. If you think you would add value to us as a guest on this podcast, you can please get in touch and let us know what you would be able to talk to us about. Other than that, we wish you well on your financial freedom journeys. And once again, thank you for joining us, and we'll see you on the next one.